All right, folks. Jeff Clark here. It is a 201. I'm just going to do a little bit of a longer introduction as more people come in. My sister tells me there's a lot of people still logging in as we speak here. So just want to give you just maybe a little more of an introduction and where the kind of premise of this webinar came from. My name is Jeff Clark. I'm a regional director here with GoldenCare. I've been with GoldenCare for 23 years now. 24. Spent my first 5 years exclusively in the field selling long-term care. I cut my teeth on long-term care. I didn't sell my first med sup or annuity or life insurance policy for I bet you 2 or 3 years into my career. So I kind of eat, breathe, and sleep long-term care. I still sell, obviously here and there when you have as many clients. I've written about 600-700 long-term care clients over the years. But my job shifted to this regional director position about 15 years ago. And so now I basically compare, contrast, review, go over different products, help a lot of the GoldenCare agents out there in the brokerage side, designing plans, talking about, whether they have a married couple that's 55 and very healthy or a widowed lady at 70 years old with osteoporosis and a compression fracture. We try to kind of guide brokers into what maybe the best solution is, the best plan. So I do spend a lot of time looking at a variety of plans. And I guess if any of us that have been in the long-term care market long enough know that there are a variety of solutions out there. We've just had to expand. Traditional long-term care, a lot of carriers some time ago, not so many now, but we have things like short-term care, home health care. We have these hybrids, these life and long-term care combo plans that became very, very, very popular. Matter of fact, the reason this came to be, about 4 or 5 years ago, I was working some internet leads, just because that's a very popular that people sell now. You join screens and as I got kind of back into the field, if you will, again, for this 3-month period, I noticed that, man, was there an influx of these hybrids. If you read the stats on this, even 10 short years ago, there was 3 or 4 long-term care plans being written for every one hybrid. And the hybrid, again, the life and long-term care combo plans. And now, if you look at the market, it's flipped the other way. It's 4 long-term care plans, 4 hybrid life and long-term care plans written for every one traditional long-term care. And I guess as I started going to the field, I kept bumping into these hybrids, and I didn't know enough about them. So I got to start researching on them, and I started to look at all of them. And really just became a competitive thing. I started to wonder, why are people buying so many hybrids? I get the use it or lose it thing. People always had that fear that, what if you die in your sleep, you never need long-term care. Well, I always just say the same thing as a car insurance plan, right? If you don't get in a car wreck, you're not going to get your premiums back. I mean, it's just so. But then we had the rate increase problem. And this is another reason why hybrids kind of took off. So with all of this, I just started putting together numbers to compete with hybrids, and I had some eye-opening findings. And so I know that I have a pair of boxing gloves on here. It's just something we kind of went with to promote the hybrid or the webinar itself. Believe me, and I just want to take that with this next slide here. This is not meant to be, some type of an anti-hybrid, because in the long-term care market, the demand is still there. We have a whole lot of folks out there that do need this coverage. But there are a lot more solutions now. And there's no one universal solution that's the best always. I mean, it's nice to have all these different arrows in our quiver to solve this long-term care problem. I personally think the hybrids are being overused because of the use it or lose it and the fear of rate increase factor. So let me start this too. The reason I want to talk about rate increases right away is because I did this seminar the first time. It's like the 5th time I've given this now, and I've come and improved some things and tried to tweak some things. And Mutual Omaha changed their rates on me since I did the first version here recently. But rate increases. The policies we're writing today are just so much more stable than the rates and the things that we saw that we wrote, I don't know, even 10 years ago, 20 years ago. I mean, frankly speaking, there's just a lot more actuarial data out there. There's a lot more claims data. There's a lot more conservative pricing models. So if you take a look at this, modern LTCi policies are much more price stable than the predecessors. These plans from 5, 10, 15 years ago. The Society of Actuaries pricing study shows that the underlying actuarial pricing assumption has been de-risked. Lapse rates now set at less than 1%. When they first wrote long-term care, they figured about 96%, 94% lapse ratio. Turns out that no one drops them. It's less than 1. Well, the investment returns. They were assuming much higher interest rate environments, and so we've adjusted a very low interest rate environment. We've got lap rates that are set right. We have claims data now, so much, 16 times more data and 70 times more claim data to go on than 15 years ago. Regulatory requirements, consumer value, company penalties, margins for error, actuarial certifications. There's so many reasons why these plans are so much more stable. So the Society of Actuaries here, again, this is in 2014. And if you look at the 2017 actuarial study that I actually saw, it's not in here, less than a 5% chance of needing a 10% rate increase. And here it's 2014, 10%. So again, these policies it's very unlikely you'll see the rate increase thing that we've seen in the past. And that is one of the big arguments for saying, well, if I buy a hybrid, I have a guaranteed premium. So having said this, we can argue rate increases. After I do a couple comparisons, you'll see there's so much more room premium-wise that if you're really worried about a policy still having an increase of, say, 10, 20, 30, you could put more life insurance into the concept and still come out way ahead. So I'll explain that more later, but I just don't want to lose any of you. Prices are a lot more stable. For those financial planners that are on here that only write hybrids, and they point to the fact that we've had rate increases, I promise you the rates are a lot more stable. So, okay. Reason to sell or buy hybrids, there's a lot, like I mentioned, there are good reasons to sell hybrids. There's solutions where people are rolling over or repositioning old life or annuity contracts that are tax-free exchanges. Then it makes sense to use a hybrid. Uninsurable health risks. Sometimes, the annuities are a good fit for that. These life, the annuity and long-term care mixes. For some uninsurable health risks for traditional, you might be able to get them into an annuity. Sometimes you're desiring to receive 100% cash benefit. It doesn't exist in traditional long-term care anymore. So those plans out there will pay 100% cash, Securian and Nationwide. Excuse me. Sometimes there's clients out there, maybe it's from their financial planner, maybe it's from their neighbor, but they're not going to buy a long-term care plan no matter what you pitch them. And I've been in long-term care long enough to know that some people are just dead set against long-term care insurance. So again, there are just situations, or maybe they're looking for a guaranteed premium. They want a 10-year paid up thing. Well, we do have this with traditional long-term care now. If some of the products out there will offer that. So, there are good reasons to sell hybrids. Okay, so if I went through this enough, one more thing, and then I want to do some comparisons. Okay, this is kind of an important slide. This is a slide, this is a concept. This is something that I have taught brokers for 15 to 20 years, if not more. That when we're designing long-term care plans, at first the long-term care industry attacked the 5% compound inflation rider. That was the big, it got to the point where we just didn't sell a 5% compound anymore. Matter of fact, I think it was the incorrect way to sell long-term care. But 10 years ago, that's how everyone sold it. It was 5% compound. It was going to be a 5-year benefit no matter what. And it was going to be, $150 a day, $4,500. And so I call this a long, skinny plan. So now I just redid some new Mutual Omaha numbers because they changed their rates. So I'm using Mutual Omaha long-term care in this example, but I want you to look at this slide because I'm going to use this concept as I'm comparing hybrid to long-term care plans. I'm not going to compare to the weakest spot that long-term care could be. So in other words, I'm not going to compare a long, skinny plan like hybrids design their long-term care benefits. Okay, it's the only option you have with hybrids. One of the limitations with a hybrid is, of course, is that you don't have as good of a pure long-term care. You can't be as flexible. You can't move inflation things around, increase daily amounts. You kind of get what you get along with the package. So with that, if you look at what a 5-year benefit, a $4,500 per month, 5-year benefit, 100% assisted living, 5% compound, policy maximum of $270,000. That's how you get 5 years, right? So if I designed a long skinny, that's going to be $11,448 with Mutual Omaha software. Okay, with Mutual Omaha long-term care. Now, as a matter of fact, let's do that quick so I'm going to put a 60-year-old here twice. Okay, so it's a 60-year-old couple. And again, if I were to do a $4,500 a month benefit, if I were to do, again, a $270,000 pot of money, if I were to put 5% inflation on that thing, 100% of the assisted living, you're going to see a premium of $11,448. Okay, that's where I get this $11,448 from. Okay, now I've always thought this is the incorrect way to sell long-term care. 90% of claims don't get to the third year. So as you get into that fourth and fifth year, it's like less than 1 or 2% of claims are going to. So I don't like spreading my benefits over a long period of time. I want to shorten and fatten them up to pay for a majority of the care when it happens. So what I'm going to do is I'm going to keep my pot of money at $270,000. I'm not going to take away anything here. So I'm going to go back over to the software again. I'm going to stay with 270, but I'm going to go with 7,500 or 250 a day instead of 150 a day. I'm going to go with a 3-year benefit. I'm going to drop my assisted living again. So 50% of the 7,500 is real close to that 4,500 that we started with. I'm going to lower my inflation to 3%. Okay. So when I do this, the premium, of course, is going to drop. So I'm going to take this down to 3%. Okay. I'm going to drop my assisted living to 50. I'm going to put this at 7,500. Okay. Now I've got 8601. So if you look at this, I have taken away nothing from this client. Matter of fact, I have designed a much stronger long-term care plan that's actually going to take care of a bulk of their needs. Remember, 90% of claims don't go beyond the 2-3 year mark. So I've now, because you bring $4,500 a month to a nursing home, that's going to pay half the bill these days. So I'm giving them a much more robust benefit and one that's going to do the job a lot better. They're still going to get $270,000 every way. Think of the lottery. Like when people win the lottery, they get offered a cash payment up front of a little less because people want their money up front. So imagine if I'm giving them more of their money up front, but I'm not taking anything away from them. They're not giving up any just by taking it up. So why wouldn't you want more of your money? You want to recoup your premium dollars as quickly as you can. So the long skinny thing is just not a smart way to design a long-term care policy. So now I mentioned 3% versus 5. There's a crossover point. So, to start out with, this benefit's $4,500, and, this one starts out at $7,500, way ahead of it. Well, in 10 years, it's $7,000 versus 10. 20 years later, $11,000 versus $13,000. So somewhere in the 27th year, this thing finally kind of crosses or breaks even, right? But again, these people are 60 years old. Average claim happens at 83, 82, depending on what you read there. So I've given this person more insurance now, more insurance for the next 25 years by doing a short, fat policy. Okay. I spent some time in this thing because as I do these comparisons, I'm actually going to use that concept. Okay. So just straight up to start with, this is Pacific Life. And I know I've been going here for about 10 minutes. That was a lot of warm up for what I'm trying to do here. So I'm going to spend a little time showing you what I'm doing here. Then I have about 6 examples. I think I've got Pacific Life in here. I've got Nationwide. I've got Securian. I've got OneAmerica. Then I did some singles and I did some married couples. So I got a couple of varieties of hybrids to show you. So first of all, what am I doing here? This is a Pacific Life hybrid. Now, Pacific Life does theirs in a 10-pay. It's the only way you can get them. So what I'm going to do here is I'm going to do a $330,000 pot of money. It's a 5-year plan, roughly. $5,000 a month benefit. Again, it's kind of long and skinny, but it's just how they do it. Okay, I'm going to put a 3% inflation rider with that. And how that works for them is you get $330,000 for long-term care, or you get a $120,000 death benefit. All right, it's either or type thing, right? So that's use or lose. If you don't use your long-term care, you're still going to get a $120,000 death benefit. What does that cost for a 65 and 60-year-old? I actually had the PDFs here just to kind of check my math. So here, this is Pacific Life's Premier Care Choice for a 65 and 60-year-old couple. This is probably a little tough to see. I can make this a little bigger probably, but okay. So if you look at the premium, for the male, that's $13,000. For the female, it's $11,000. So if I add those together, I'm going to come up with a premium of $44,088. That's what it costs to have those benefits. So now I'm going to match these benefits. I'm going to actually use NGL's long-term care for this because it's a 10-pay. Mutual Omaha can't get a 10-pay. So I'm going to do a 10-pay NGL premium. And then instead of giving, and what I need to do to match this is I need to have a $120,000 death benefit for a 65 and 60-year-old couple. So I did a couple things here. The first one, I just did a second to die life for $2,010, and I ran a long-term care plan with $5,000 benefit, $330,000 month, total benefit, $5,000 monthly, 3% compound. And so the rates I came up with, well, first of all, for the NGL plan, here's a 65 and 60-year-old couple. 65 and 60, same benefit as that we just saw in the Pacific Life, and that premium came out to be combined $12,760. So I'm going to go back to my PowerPoint here. I'll show that's where I got the $12,760. So this is the LTC premium. Then I need to mix in a second to die life. That's right here. Okay. I used Columbus Life for this example. And you can do this with any life company, any long-term care company. It doesn't make any difference. I found Columbus Life to be pretty competitive for this one. So here you'll see the premium here for, again, a 65 and 60-year-old male, female. The modal premium on this, $2,010 annually. So it's going to give them $120,000 death benefit. All right. So instead of paying $44,000 per year, wouldn't it be a lot smarter to pay $12,000 and add a second to die life on there for $2,000? Now, the first argument I had a gentleman from Rhode Island that chimed into me after I did this the first time. He said, they both get a death benefit of $120,000 on that. I said, you know what, you're right. I got to be fair there. So then the second one here is I went ahead and ran an individual 65 male for $120,000 death and a 60-year-old female for $120,000. Those rates were 28. These are individual indexed universal lives is what I used for this. So it was 28.12 and 15.27 to have them, so they each get a death benefit. So no matter how I do this, either a second to die or they each get their own, I'm still adding the same $12,000 long-term care premium in there. My totals are $14,000 and $17,000. Now think about this. Come claim time, which is 20 years down the road, and again, average claims happen at 62. I'm going to have a death benefit, or I'm going to have a plan here that's going to be paying me $9,000 a month 20 years later. And that total long-term care benefit's growing to $596. Now remember, if I don't use that, I still get my $120,000 death benefit, right? Either or. Look at that premium. So for 1/3 of the premium, I can get both benefits guaranteed. So whether I need my long-term care or not, if you use up all the long-term care, you don't get a death benefit. Well, here I can use all this death benefit, same long-term care benefit. I'm still going to get a guaranteed death benefit. And down here below, I'm going to get $559. Plus, I'm going to get $240. I'm going to get, actually, this one should be $240 as well. They each get a death benefit here. So for, again, 1/3 the premium, I get the same benefit, but actually I get both benefits, not either or. So this is one of the first times I ran into it. When I'm out there in the field, I'm thinking, why on earth are people buying these? What you're doing when you're buying a hybrid plan is you're buying a grossly overpriced life policy. And I mean grossly, like ×5 what you find in the market privately. So somehow marrying these plans together, your client is taking it in the shorts. And I mean, not just a little bit, a lot. Okay. Remember, long-term care has a tax deduction for premiums. There's just so much reason. Just take a look at this one. This is, and again, I'm going to do the same thing here. Now, I'm not going to show you all the PDFs to kind of back my point here, but I do have all this stuff's backed up with, current rates, etc. So let me show you another example here. The next one I think I did was Securian Life. Okay. So Securian's hybrid is also 10 pay. So here, what they did here, I did $121,000 benefit, $5K benefit. Ends up being about a 2-year benefit, 2.5, 3 years. $120K death benefit. So I ran the same. So Securian's price on that, $21,690. So I take an NGL in this particular, because they have a 10 pay. The long-term care premium on that was $8,000. The second to die, again, of course, for this couple was still $2,010. Or if I did them individually, one for each, because they each get with this Securian, they're each getting. So either $10,000 or $12,000. Again, $8,100 for the long-term care, $2,812 for the male to get $120,000 back, $1,527 for the female to get that back. So again, somehow when you put it into hybrid, that life premium grows to like $10,000 for some reason. Okay. So what does this look like? Again, so here we go. For $21,000, I could have a $9,000 a month benefit 20 years later, or a long-term care benefit of $219. Okay, or a death benefit of $240. Again, this is $120,000 for each of them. Okay, or down here for half the premium, I can get the same benefit for monthly from long-term care and total benefit, and I get a guaranteed death benefit whether I use long-term care or not. I mean, why would I have to pick between these when I'm paying twice the premium? Doesn't make any sense. Okay, so then to be fair here, I ran both death benefits. Still came up at $12,000 versus $21,000. Which one's a better buy to you? To me, I know that people are worried about rate increases, and I know they're worried about use it or lose it. But at some point, if you're worried about use it or lose it, I'm giving them all their money back guaranteed, even if they have a long-term care. So I'm taking care of that easily. Rate increases, look how much premium you had to play with. Let's just say I want to double those death benefits. So just in case long-term care takes 100% rate increase, which I just pointed out is very unlikely, I could double my long-term care or double my life benefit and still come in well under any of the hybrids out there. Okay. So, all right, let's do another one. Nationwide. This is Nationwide. Now, this is actually a lifetime pay. This is paid to age 100, guaranteed premium. Nice little plan. So, I'm going to use Mutual Omaha long-term care because it's a lifetime pay. So what I have here is I have a married couple. It's 55 and 50. The benefit Nationwide does here for $185K, $5K a month benefit, about a 3-year plan, 3% compound. And what they do again is they pay that $120,000 death benefit in case you die in your sleep, never need long-term care. They're still going to give you $120,000 death. So it's a nice little hybrid here. The cost for that for a 55 and 50-year-old couple, $9,356 per year for 30 years. So down here, and again, I got mutual software open. Let's do this real quick. Let's do a 55 and a 50-year-old. So 55 and 50. Now, I mentioned before, so this benefit here is 185, 5K, and 3%. So let's put that on there real quick. Let me put 185, 5K, 3%, 5211. This is Mutual Omaha's new rates, by the way. The first time I did this, that rate was about 4,200. So Mutual really went after the 3-year plans, and they went after the 3% compound. If you've looked at Mutual Omaha's new long-term care rates, the 3 areas they hit the hardest: 3-year plans, married couples, and 3%. Exactly what I just designed. Thank you, Mutual. But if you'll notice, I talked about the shorter, fatter. Now, again, that premium, used to be $4,200. Matter of fact, let's see. If I go to Indiana, that hasn't changed over yet. Let me see. That premium was $3,563, right? So this argument was really sound there. I had $3,563 in there. All right. And for the younger age, it's a little tougher. But so what I've done here is to match out this benefit. So later on down the road, so my benefits pay out the same. I kind of got it around Mutual. I took the sting out of Mutual's new rate increase. And this works, by the way, call this a side point in this seminar. This is how you can take the bite out of Mutual's recent rate increase. I take my benefit up to about 180%. So I'm going to move this to 9,000. Move this to, I think I put it at 260, 300,000. Okay. Put this at 300,000. And again, now 50% of 9,000 is still 4,500. So it's the same benefit I had before on assisted living. I increased this, but I'm going to lower my inflation back to 1%. I know it's not a partnership, but I don't want to talk about that quite right now. This is Indiana. Let me go back to Alabama. Okay. And actually, Alabama still does work for partnership. So, okay. 4713. All right. So there's a premium I'm using. Okay, the benefits, by the way, are these. On this next slide here, they're going to pay out the same here. So I got it to match up as far as the crossover points. Okay. So 4713, a life premium now for someone who was 55 and 50 for a second to die life at $120,000 is only $1,232 at that point. If they want to buy those individual plans I mentioned, so they both get $120,000 death benefit, it's $1,556 and $942 for the husband and wife, 55 and 50. The long-term care premium, of course, is 47, so I add all those totals up. Either way I do this, I come in well under, again, half the premium, twice the benefit. I don't have to pick between or this or, hey, look, if I use long-term care, I still get my death benefit, or vice versa. So, again, just look at the premiums. Payouts are the same here. Little lower because I lowered that 1% on the total. Actually, you're going to be 65 and 60 becomes a little stronger. So, and again, if you wanted to increase this long-term care benefit a little bit, you could throw a little bit more in the premium there. You could increase it to, I don't know, 400,000. So it's even. In other words, there's a lot of room to play with here when you're almost $4,000 under in premium. Okay, so let's look at another example. This is Nationwide, a little older. You notice this sets up a little stronger. So the older people get, this concept I'm showing you, the stronger it gets. So for clients that are in their 50s, it gets a little tougher to get the huge advantages. It's still going to be better. But when you get to start talking about people in their like 60 or 65, it really, the hybrid thing gets to be a less and less attractive deal for those folks. 15,000 for, again, this is 185K, 5,000 a month benefit, 3% compound, $120,000 death benefit. This is nationwide's Care Matters, it's called, I believe. Yeah, Care Matters too. The premium for that, $15,581. So I'm going to take, again, Mutual Omaha and run the same benefits. $64.25 for the long-term care part of it. The second to die life is 2010. If I did, again, two separate individual universal lives for the 65 and 60-year-old, the premiums on that were $28.12 and $15.27. Again, I had those in I used Columbus Life for those, just for those of you keeping score at home. $15.56, and that's for the 50-year-old. So I had that one open. Pac Life. Oh, this is shared. Bear with me here. So $120,000 female by themselves. This is an individual universal life. Okay, for a 60-year-old, premium on that $15.27. Too many things open here. I'm starting to there's a $15.27. Suffice to say the males is $28.12. Okay. So again, and you can use any life company out there. I mean, I've done this with AIG. I've ran numbers with Prudential. I've ran numbers with Mutual Omaha's life plans. It doesn't really matter which long-term care and life you're using. I'm just imploring on you, separate the plans, and you'll come up with a lot better premium and a lot better benefit for your clients. It's $8,000 versus $15,000, or $10,000 versus $15,000. And the benefits, again, it's the same stuff, same payout, but I'm not having to choose. Because again, if I gobble up this long-term care benefit, I get Alzheimer's, I'm in a nursing home for 4 years, I don't get my death benefit anymore. Why would I do that? Why wouldn't I pay half the premium and guarantee me both benefits? Or again, if you want to buy the double, and if you're one of these people, I've had financial planners that will come after you and say, yeah, but what if the premiums go up 20 or 30%? First of all, I don't think they're going to anymore. But if they did, I could add another $240,000 this and still come up at a lower rate. I can't see the argument for the hybrids. I have a hard time with it. But again, unless they have some money that was rolling over from an annuity, or they won't buy it, or those reasons I talked about earlier. In a competitive situation, you find me someone who's going to buy a hybrid. If I show them this, I can guarantee you 9 times out of 10, I'm going to get that sale. Okay. All right. So let's look at OneAmerica. That's kind of the big one in the house. That's what everyone compares, talks about. Okay. So OneAmerica, they do 33 months or they do 50 months, and they have, the initial benefit pool, and they have a continuation of benefits. So that first 3 years is the AOB. And then if you wanted to get unlimited policy, it's the continuation of benefits. And I have an example for that too. So I wanted to show this particular one is against a single male 65. These things work out a little better when you go against couples, but so I want to be fair, and I want to go up against a single male age 65. OneAmerica, if I want to have a $166,000 death benefit, a $5,000K a month benefit for my long-term care part, and that gets me that death benefit, of course, of $166,000. So the death benefit's $166, the long-term care benefit's $166 at $5,000 a month. Again, either or, but okay. So I'm going to put 3% compound on that, on the AOB only, right? Just on that first part there. Okay. To be so everything's equal. So my LTCi premium on that is $1,805. My life premium for this 65-year-old, I used again, this is an indexed UL, okay, individual premium there for that single male, $38.91. I add those together, $56.96 compared to $8.98. One of these I used inflation. This one has no inflation. There's their rate. Then I went ahead and put that inflation rider on the AOB only for the OneAmerica here. That rate then became $10,025. So then I went ahead and put the inflation with my long-term care plan. So of course, then that became $3,023 for the long-term care. Same $38.91 for the life portion of this. So that totals $69.14 as compared to $10,000. Again, a full $3,100 less. Both these examples are about $3,000 less. What does it shake out at? We'll take a look at this. So essentially the same benefit, but I'm not having to do either or. If you use your long-term care benefit, $166,000, you're not getting your death benefit. Okay. But here, for a lot less premium, I get my long-term care benefit and a guaranteed death benefit. Twice the benefit, 40% less premium. Same thing here if I do it with inflation. But here again, the inflated values are both 225. So, claims are going to happen for, I'm assuming 20 years later. So I ran this at 20 years later. Same benefits, just a lot less premium and tax deductions. And I could go on and on. All right, so then I did the same thing here with a single female. We're getting close to wrap it up, folks. I know I've thrown a lot at you, so bear with me. You can do this with any hybrid, and you can do this with any long-term care and life combination policies. I've been playing around with so many different companies on this, and I don't care what hybrid you bring me. If I separate them and give you a separate long-term care and a separate life, you're going to beat it. So this is an example with a younger female, 60-year-old female. No inflation is $5,700. A life and long-term care, separating them out, add them together, $4,068. Again, considerably less. If I put inflation in that long-term care benefit, again, $8,500 with OneAmerica. Again, that's inflating the first 33 months at 3% compound. So I do that with long-term care, which is going to inflate all of it. $5,300. So again, $3,000 less in premium, or whatever you want to call that, 40% less in premium for benefits that are going to be the same. But they're not the same because I get both benefits guaranteed. I'm not picking. Just again, it's both benefits, less premium. Twice the benefit, 40% less premium. All right, so what else we got? Married couples. Couple more, we're going to wrap up here. 55 and 50-year-old couple, same 33 months here. Okay. So this is the married couple, and again, I'm going to, do I have one with the same thing with 60 and unlimited? Yep, I did unlimited. Okay. So here, I'm going to fast track. We're going to jump ahead to the 65 and 60-year-old just because I'm throwing so much at you. It's the same thing here. It's a little redundant. So again, this is a 65 and 60-year-old couple. So if I do this, and on this one here, I'm going to give you two examples. Because one of the strong parts about OneAmerica is they have an unlimited benefit. In other words, you can add that continuation of benefits, and that benefit goes on forever, which you can't find in the long-term care market anymore. Not that you necessarily need it. It's pretty rare that claims go beyond 5, 10 years, etc. But okay, if that's the hot button. So what can I do? The best I can do here is, first of all, if it's just the AOB, okay, 65 and 60-year-old couple, 33 months, $10,243. Again, the second to die life for these folks, because remember, OneAmerica, I should have mentioned this, OneAmerica uses a second to die life inside their policy. That's why it's usually cheaper than the other hybrids out there. The other hybrids, a lot of them are going to pay you two different death benefits. OneAmerica is using a second to die, universal life. So, for me to compete with this makes it a lot easier. So my second to die life policy is $2,063 for a 65 and 60-year-old couple for $166,000 death benefit. Premium of that is $2,063. The long-term care portion, $5,503. Add them together, I'm at $7,500, where OneAmerica is at $10,243. Now down here, this is OneAmerica's unlimited benefit. So if you want that benefit to be unlimited, all right, so both on the AOB and the COB, we're going to put inflation. So I'm going to inflate, of course, the long-term care plan here. So that premium for OneAmerica for the 65 and 60-year-old couple, unlimited benefits, unlimited with inflation on both the AOB and the COB, $19,153. Whew, I know it's hard to even imagine picking that premium up, but people do buy them. All right, so $19,000 per year. If I ran into that couple, I would tell them, what you should do is you should just go ahead and buy a long-term care plan, get your tax deductions on this. It's $10,747 a year. And then I would get the second to die life premium for $2,063. That's a total of $12,000, not $19,000. And by the way, the benefits, and I know I'm going to go right to the unlimited one. I know that can't get you an unlimited benefit, right? But I can get you $1.348 million in coverage, $674,000 each. I mentioned 90% of claims don't go beyond that 2 and 3 year mark. 95% don't go beyond 4. So I've seen different stats on this, but you talk about getting beyond 10 years of care, it's less than 0.5%. It's a long shot. Then I'm taking you all the way to $1.348 million. This works out to about 15 years of care. If you're using the cash option or the home care, 30 years of care. So this is it's not unlimited. It's the next best thing. But remember, it's considerably less premium, $12,000 versus $19,000. Okay, and you're getting both those benefits. And up here again, same thing. Claims are going to happen 20 years later, so I extrapolate the benefits out. And by the way, on this long-term care, I know I'm not giving you an unlimited benefit, okay? But I use $10,000 per month. Actually, I got to change this right here because I use $10K. There should be 10. So in other words, and I put a shared care on there, right? So they have basically, between the two, one person could use as much as $1.348 million. Their monthly benefit is $13,000 as opposed to $9,000. So I'm killing them on the long-term care benefit. I'm not, because of that, I'm not unlimited, but darn near unlimited. It's close you're going to get to unlimited. And my premium is a big thing here, $12,000 versus $19,000. Again, if I run into this couple and they're looking at $19,000 and I come by and I show them basically $12,810, I feel 4 to 5 times I'm going to make that sale. Okay. All right. One more thing I want to point out to you, and I'm going to go ahead and just turn this over to questions. Is been kind of a lot. There's a lot of talk out there. People are worried about the use it or lose it. So much so that a lot of these financial planners and some agents are kind of telling people that, that long-term care is not worth it. You pay all that in, you die, you don't get it back. What you should do is buy this hybrid. All right. So if people are that concerned about getting their money back, which I get it. I mean, I totally understand because I've heard it. I've been in the field enough to hear that complaint or that objection. Mutual of Omaha has this neat little thing in their software. In fact, I'm just going to bring this up again here. This little thing is return a premium rider. So if you're worried about getting some of your premium back, so let's just put this 55 and 50-year-old couple, and I'm going to put a $10,000 a month there. I don't care about inflation here. I got like 1% on this, whatever. All right. Because again, Mutual's new sweet spot, double your monthly benefit and drop it to 1%, and you'll kind of erase a lot of that rate increase we just took. And quite frankly speaking, I like going a shorter, fatter policy. It ends up being a better way to design a plan. And remember, so much care happens in the short run. A higher benefit just means these guys have $10,000. If you have a $5,000 a month benefit, you go to a nursing home, you might be a little short. It's going to be $6,000, $7,000, $8,000 in the Midwest and East Coast. You're all at 10. So I like starting my benefits at 10,000. But when I do this neat little times 3 down here, a lot of people overlook this. So the premium here is $4,900. If I add this times 3 maximum monthly benefit, it put $400 on my annual premium. I mean, negligible. I mean, it's like $400. It's still $5,000 a year. Okay. So if I told this person, look, you're 55 and 50, so claims happen in 30 years. Let's just say between two of them, you're going to pay $5,000 a year for 30 years. That's $150,000. Okay. Maybe the husband pays for 20 years and she pays for. So I put that in there. What this does, this pays me 3 times my monthly maximum benefit. 10,000 times 3 is $30,000. So they're each going to get back $30,000. These people are going to get $60,000 back. They're going to get half of the premiums they paid in back. It costs them next to nothing. So now if I want to do that in a hybrid, remember, I got to double my premium. I got to go up to $10,000 to do that. So if you have some clients that maybe, you know what, if you gave me half my premiums back, I think I'd be more apt to buy this. I don't have to go and spend another $5,000 a year to buy a hybrid. But so if you have people that just, if I could give them half, 60% of their premium back, they might go for that. Because again, look at someone who's maybe, 60 and 60. Right? It's still a pretty little load. Now about 20 years later, so their premium 20 years at 120,000 total. If I put that in there, let's see, their premium is going to be 62. So at that price, I'm giving them half the premium back for a very small little load. So that's just another thing that people overlook. So if you have that use or lose a person, first of all, don't go to a hybrid. Secondly, take a look at Mutual's times 3. Their return premium rider on there. It's a neat little benefit. Okay, it's times 3, costs next to nothing. You can keep adding all the way to the people till they're over age 65. So that's a nice little thing. Okay, for that, I'm going to wrap this up. Now, again, folks, I hope those of you sitting out there that are just only right hybrids, I hope it was an eye opener to you. I hope I didn't hurt any feelings, or it's not my. We do represent these companies, and they're good companies, and they're good products, and they fit in a lot of areas. But I'm just here to say confidently, there are too many hybrids being sold out there for the wrong reasons. Okay, they're just to try to not have use it or lose it, or to have guarantees. Folks, you can do that. You just give them a death benefit in the side somewhere, so they get sell them a separate life policy, so they get all their premiums back. All right, so you don't have to steer them to a hybrid to accomplish the use it or lose it or the guarantees. All right, there's a lot of other ways to do this that can be a lot more premium friendly. You get your tax deductions in your long-term care. And frankly speaking, the long-term care of it, you don't have a reimbursement model with all these hybrids. Some are going to be cash, some are reimbursement, but like OneAmerica is not a cash version. So you're giving them a lot better long-term care benefits, which is really what we're trying to solve to begin with. Use the correct tool for the problem. I'm a big believer that traditional long-term care is the best way to solve the long-term care problem. It's not even close. But there are situations where people have had some dead money in a life contract, or they want certain things. There's a time and a place for hybrids. They're just being overused. So with that, I'm going to end this. It's 40 minutes. I'd like to try to keep this around 40 minutes. So I'm going to look at questions now. I'm a little afraid here, so I'm going to open this up and see if I can't answer any of these things that came in. Yes, lots of questions. So let me just read a couple. Thanks for that, Corey. Someone recognized. Screen's good. Sounds good. Thank you. Well, actually, not too bad. So I had someone ask me again if they were guaranteed ULs or these are indexed guaranteed in some situations, universal lives. Most of the questions I'm reading here, folks, are just coming into, which life policy was, etc. So I'll just say what I said earlier again and wrap this up. I got another one. Why not include home health care waiver? Since most want to stay at home, I guess, you could add that home care waiver to almost everything I did there. It's going to add about another 10% of the premiums. Remember, the cash portion that's built into mutual always comes first day. And so, I can go back and forth the home health care waiver. You can receive cash for a while. It's a calendar day elimination with mutual. I do like putting the home health care waiver in my plans. I don't always do it. When I'm doing a competitive mode, I sometimes don't. But yes, you could add home health care waiver. You're still going to be well underneath any hybrids. Got another question. Someone asked me if it's my birthday today, which it happens to be. I'm getting a lot of teases on that. So yes, it is. Thank you, Tom, and Corey, and Chris, and yeah. So folks, listen, not a lot of questions about it. A lot of people are asking, what other carriers can you use? What other life products can you use? I guess I've done these folks with, again, IULs, indexed universal lives. I've used it with, second to die. I've used it in first to die. Even someone, a living promise, an overpriced burial, or over $30,000 burial for someone to, suffice to say that, and I've said this before, so I'm just going to be redundant. If you separate and use any life policy and any long-term care policy, and you separate them, you end up with a lot less premium, a lot better benefit for your client than selling a hybrid. So with that, listen, no other real major questions here. I want to thank you so much for coming on. I do have our number on here, 800-842-7799 is our number. I'll make that a little bigger so you guys can see that. And if you have any questions, you can also email marketing@goldencareusa.com. I know a copy of this presentation will come to you automatically. So with that, I'm going to go ahead and leave that screen on there. And I want to thank you so much for coming on board today. Give us a call and we'll give you a copy of these slides. Or if you have a case that you're going up against a hybrid right now, give us a call. We'll run you some numbers. If you're folks that don't have life through us, we do have some life contracts available to add those products for you. But again, just I want to say a big thanks for coming on board today. And good luck selling out there, everyone.